The moment of truth is at hand. We're just days away from knowing whether the Fed really will raise rates for the first time in 9 years. Let's assume that they do and ask what effect that will have on world markets. I've been talking about that here at Yale University at the Future of Finance conference with a number of experts from around the world, and the answers might surprise you.
Probably not much. This has been talked about so long, and there's some truth to the efficient markets hypothesis. It's a half-truth as I regard it. But when something's talked about so much and it actually happens, maybe nothing. There might not be any reaction. Unless, there's some further talk generated by it or some other events associated with it.
In broad terms, fixed income markets will decline from moderately to significantly when rates start to rise. And the interesting thing about that is that unlike equity markets and trying to predict the effect on equity prices, the effect on the price of bonds when rates rise is mathematical. So the longer duration your bond portfolio is, the more the price will decline when rates rise, all other things being equal. This is particularly dangerous because many people don't understand the risks they're taking. And so financial advisors will often guide people towards investment grade, for example, over high yield because the perception is that the credit risk is lower, and it typically is much lower in investment grade than it is in high yield. Or they'll guide people to invest in municipal bonds because of the positive tax effect and the perception that there's a government backstop. But this is really credit risk people are talking about and not interest rate risk. And with rates as low as they are, the next 5 years are highly likely to be dominated by interest rate risk and not credit risk. In the last few years, since the credit crisis, dealer liquidity for corporate bonds has diminished significantly. So what many people don't realize is that in order for us to trade bonds, we don't sell our bonds from one hedge fund to another hedge fund or one mutual fund to another mutual fund. We sell them to a dealer who then sells them to somebody else. So we need dealers to have enough liquidity to be there as buyers. And if they're not there as buyers, the price will drop considerably. The statistics are that dealer liquidity is down by more than 50% since the financial crisis, whereas the total supply of high yield corporate bonds outstanding has grown by more than 50%. And that mismatch creates the real potential for a significant problem or dislocation in price if there's a catalyst, such as rising interest rates, to drive prices down.
Whether in a rising rates environment, our fixed income asset classes are going to get hurt more than equity markets affected by rising rates environments. Looking at long-term data, the answer is actually not obvious, meaning that with disparity underperforming in a period where rates rises depends on how stocks and bonds do relative to each other. And whereas it's obvious that when rates rise, bond prices tend to fall, it's not obvious what happens to equity.
I think if the Fed does go through the rate hike, which I think they should, I think it will be good for dollar-denominated assets. And I think if the rate hikes will be very gradual, maybe they'll only hike it once or even maybe at most twice in the next 6 months to 1 year. I think some of the fixed income assets denominated in US dollars will still be relatively safe investment choices relative to equities, which I think are still mildly overvalued. I think the impact on the rest of the world, in particular China, I think unfortunately will still be quite deflationary. I think the devaluation of the yuan itself is deflationary because the yuan is not yet a primary reserve currency, and the US is. So I think commodities, oil, everything is traded in US dollars. So I think if dollar goes up, that's also deflationary. So that will put downward pressure on emerging market assets, including possibly China.
So far, the effect on the emerging markets, I think, has really hurt sentiment. And if we look over the last 20 years, one of the things that correlates with a risk aversion that really affects the emerging markets is the level of volatility in the US. And so seeing the VIX over the last 2.5 years has correlated very well with risk aversion in the EMs. So I think the whole issue of sentiment has been really driven a lot of this risk aversion in the EMs specifically, and that's something that we see a 20-year history of. If the Fed does raise rates next week, and we'll see, the speculation is right now that they won't, I think we'll see different effects on different countries. So we have several countries who have lowered interest rates that include Mexico, Thailand, Poland, Hungary, etc. And they have plenty of policy room to maneuver. I think you'll see not so much effect on Mexico, India, and the Philippines because they've got in a good position, two of them on current account, one of them on being tied to the US. And so I think we will see short-term turmoil for all the countries, but we'll have a more V-shaped recovery for ones that are in better shape, particularly on the current account.